Previously on Dry Powder.
Feels like a lot of these management teams have just never dealt with this level of inflationary pressure before.
Shawn O'Brien, an associate partner in our commercial excellence practice, explained how private equity houses are racing to get ahead of inflation. But once you get past those initial price hikes, the question remains, how do you stay ahead of those inflationary pressures for months or maybe even years out?
These things have the most success when you actually tie them to your weekly, monthly, quarterly, annual business reviews or finance reviews or a combination of both. Actually building in an inflationary response into those discussions is going to go a lot further than standing up, say, a completely separate process outside of the heartbeat of the business.
I'd argue that if you're a private equity firm and you don't already have these scorecards and these dashboards, you're late, because we have no idea how transitory, quote unquote, this inflationary period is going to be. We've already seen 9 months of it. And if you don't have a structured approach and you're not dealing with it across the portfolio, you're late to the party and you need to really accelerate what you're doing. Today on the show, I'll ask Shawn how private equity firms are building dashboards. We'll also see how they scale a conversation so management teams can learn to combat shared threats together. I'm Hugh MacArthur, head of Bain's global private equity practice, and this is Dry Powder. Let's say I'm a private equity firm and I've gotten through this first round of price increases. I've done my bad news to the customer. You're talking about a lot of complex things that I need to do with pricing at that point in order to ensure I'm maintaining my margins and my market share. How do I do that across a portfolio as a private equity investor?
First, we want to build what I would call an activity scorecard. So what are all the actual specific pricing actions? So we're on customer segment ABC, product XYZ, we're going to increase price, 10.5% on this exact date. And actually just doing that action by action build up in kind of a red, yellow, green, so that as you go along the expected build up or run rate build of the pricing actions you're taking, you're getting it. And you're collecting feedback from frontline sales and actually getting a sense of, okay, if pricing actions aren't stick, what are the mitigating actions we need to put in place? The second would be what I would call a realization scorecard, which is just budgeted versus realized price. And the amazing part about some of these inflationary adjustments is it happens really quick. So for the company we were just working with, probably on average across all their portfolios, right? They had some areas they took a ton of price. They had some areas they actually are just eating margin because they're not in a good competitive position. The customer experience in that specific segment isn't great. They just can't take the price. Probably blended, it was a 700 to 800 bips increase across the company. And so 90+% of that bips were actually realized by January 1st of 2022. And the work was kicked off in August. So just to give you a range of timeline, it's actually a massive impact to the firm. But what you can do is, because you have the actions, you have the dates, et cetera, you can actually do a really robust budgeted versus realized, are we or are we not on track for where we go? And then the third way to look at it is building up a churn or a volume scorecards, particularly say if you're in the SaaS business or if you're in a business that has a lot of consumables and service. You can actively monitor underlying volume impacts and be able to adjust up or down depending on whether you see volumes head the right or wrong way.
If you constructed an inflation scorecard, as you call it, for one firm potentially in the portfolio, can you scale that same scorecard in your experience to others, or does every firm require a unique set of metrics and indices? Are these bespoke, or is there some pattern to them?
I think honestly, there's some bespokeness as you break it down, but like any other scorecarding or dashboarding, we can just create a hierarchy, right? So if you're talking about a specific business within a specific country, you're going to have a lot more detail on that dashboard. You're going to actually be looking at your product segments, your customer segments, et cetera, and where the price is rolling. In the case of what I've seen, we'll have those business unit scorecards roll up to a much higher level of realization at, say, a regional level or a P&L owner level. And then for a private equity owner who has a portfolio of businesses, it actually can start to go at a much higher level. So in this case, what was the total budgeted run rate inflationary adjustment that we were expecting to see? What percent are we on or off track versus the point that we're at? And then at the highest level, what are the kind of main drivers, positive and negative variance? That one page, you can have any portfolio company build and expect a management team to have high conviction and understanding as to what's driving the over under performance on the adjustments.
And do you see the best investors actually tracing and calculating the impact of inflation on their value creation plans, especially this year when things are so upended?
Yeah, well, it's a couple things. So obviously tracking and understanding the impact of inflation on value creation plans within an actual owned portfolio company. I think in the diligence process now, it puts an increased emphasis on understanding for price what are these firms doing, or what have they done? What are they in process of adjusting, and do they have it on their radar to take further adjustments? Because these can be some pretty wild swings in the revenue profile and cost profiles of the company. And then third, I actually think the most effective firms I've seen are the owners that are actually starting to look across their portfolio companies and applying learnings from one portfolio company or what one portfolio company is seeing to another. Because I mentioned, hey, a lot of these indices are well known. You can go online and find any inflation index and forecast, and they'll forecast anywhere from 6 months to 3 years easy. Everyone's looking at the same data. It's what people are doing with it, how they're interpreting it, and how they're reacting to it that actually is creating some differential performance for some owners.
Where do we get good data on pricing, and how does it vary by type of firm?
Yeah, it's a great question. A lot of PE-backed firms and newly acquired firms, their systems are all over the place. So, it's not uncommon if we go in that there's 10 CRMs and 3 ERPs, and actually creating transparency across all the components of cost, both direct and allocated, is easy. So a really good starting point is, first and foremost, doing the web scraping, doing the actual walking the aisles to figure out what the landed price is for a retailer, walking back and actually looking at the contracts and the terms to both get kind of landed in net price. And then building in any of the additional costs that aren't directly allocated to a customer, like freight and logistics and transportation, et cetera, to build at least what we think is a directional waterfall or a gross to net waterfall. And then using that to poke and prod and figure out where the biggest opportunity is. Because honestly, what I found is you go through a ton of effort to get all this data. And the first question is how do we bring it together? And it actually spurs a really good IT conversation and a really good value creation discussion outside of, say, pricing. But the starting point is figuring out where the hotspot is and using that as an ability to dig in.
That's a really good point. And I think it really resonates in a B2B environment where many companies, if not most, in private equity portfolios are mid-sized companies. The mid-sized B2B company on average has a poor understanding and a poor data set of what their pricing really is, who can influence it, and how that changes over time. We looked at a can manufacturer some years ago and found that 20 separate people in the organization could have an influence on the realized price of a product, and they were not working together. There are people on the plant floor who can make decisions based on order size. There are salespeople who can make decisions. There are people at corporate that can make decisions. All have input, and at the end of the day, the company may not have very good data on what they're actually realizing for their product and service to begin with. So the starting point seems to me to be, let's go and get the data. Let's understand our pricing process, number one. Number two, get it under better control if that's required. Number three, then figure out, really, no kidding, where's our floor? What levers do we need to pull? And how do we track that over time?
Yeah, that's actually a really interesting point, because with the client that I'm working with now, we've quickly pivoted to, okay, we're seeing success of the pricing adjustments in market. And one of the avenues that we're now starting to look at, if you think about the pricing waterfall, which is what you're describing, actually going down from your list to gross to net and thinking more holistically around, discount authority of frontline sales, all the below the line discounts when you think about freight and payment terms and everything else, and whether you're enforcing contractual obligations. There's actually a ton of money that ends up falling through the cracks when you actually have good visibility on kind of your gross to net framework. And that actually becomes a really compelling way to, in effect, increase price without actually increasing price.
It's fair to say that most private equity investors don't have a lot of expertise in dealing with inflation and having the same kind of rigorous playbooks they do in cost, as we've discussed. But this sounds like it's a very threatening thing. Obviously, cost inputs going up is a very threatening thing. Figuring out how to deal with something that may be very significant in terms of its impact on my economics, my value creation plan, that feels very threatening. Is there a way to think about this inflationary opportunity and the ability to just get much more rigorous in how you think about and implement price changes in business so that this is an opportunity as well as a threat for companies?
Yes. I think this inflationary pricing response has opened a lot of eyes for firms around the impact that price can have and how quickly it can drop to the bottom line. And thinking about it is, okay, how do we think about pricing more holistically than just inflation and pricing the cost? And so we see a lot of firms, after putting through this initial increase or pushing through this initial, what we'll call market adjustment, starting to look more holistically around, once again, kind of the gross to net. But then how do you think about more structural pricing opportunities within the company? So how do you think about taking a refreshed look on your price positioning within the market? thinking about how you set your prices and the data that you use to set prices and how often you set prices and how you bake that into your kind of monthly, quarterly, and annual business reviews. And using price actually to not only drive an effective margin, but also communicate the right message that you want to communicate to consumers.
I mean, you're really talking about pricing to value. And pricing to value is something that a lot of people do talk about, but it's rarely done. There aren't really a lot of playbooks that I've seen that implement pricing to value in a very rigorous way. And this inflationary environment may paradoxically give us the opportunity and the incentive to actually, in the private equity industry, start building out those rigorous playbooks to the extent we don't have them today, to really make price to value a systematic part of our VCPs going forward.
Yes. And to price the value, you have to have an intimate understanding of your customer. And I think what we find a lot of times is we're pricing it to what we believe the expected value is or the inferred value is. But when you really dig into it, and you start to augment with robust consumer research. So if you're going to do, say, a conjoint analysis or something along those lines to understand the trade-offs of your brand or your offerings versus competitors in the space, reflecting in inflation adjustments, et cetera, I think what we're finding with a lot of clients is they're surprised at actually what their consumers are saying important, how they view the brand, whether it actually is premium or it isn't premium, or actually it's higher than they thought. It's opening a lot of questions and opportunities to actually do that and price the value to your point.
Fascinating. Now, we spent a lot of time talking about pricing and how to thoughtfully pull the pricing lever in this type of environment. Do you also see private equity firms reimagining their cost-cutting playbooks in light of the inflation?
Yes, absolutely. Just given the valuations and the multiples and where they're at and how stretched I've seen a lot of value creation plans be, people are after really leaning in on cost programs just to maintain the cost base, let alone actually drive some of the value that are necessary to make the deal thesis work. And so a lot of them are becoming perhaps even more aggressive in how they think about costs. So if we think about things like zero-based budgeting or zero-based redesign, if you take that playbook and think about, well, if you're facing input pressure, labor pressure, logistics pressure, et cetera, the typical levers that we would see owners go for, or we see companies go for, the playbook they're operating by is first, I'd mentioned you need to get visibility. So tied to the pricing process, the visibility you're creating on cost pressure is actually driven by a really good understanding of your cost. What are the drivers? How do they influence the cost base, et cetera? Second, we see them just differentiating a lot between what I would call strategic and non-strategic spending. So the really good firms actually know what those signature customer and employee experiences are, and they will protect that, particularly aligned if that cost is in support of the broader ambition and strategy. And then if it doesn't support it, it'll differentially get whacked. We see a lot of firms unpacking the drivers of spending. So actually trying to get down to the rate that's being paid and the consumption. And then from a consumption perspective, thinking about how do you reduce consumption with things like spending czars or control towers or otherwise. And then where possible, where firms can pull back or automate work, they're doing so. So I think you see a pretty effective combination of, can you beat down the cost increases that the firms are seeing? Can you price up to what the implication would be? And if you do both of those effectively, you actually have a margin expansion opportunity. And so the firm that we just wrapped up this major inflation work with, I mentioned, 700 to 800 bips of price that has gone through and is in the process of being rolled out, and all signs are pointing positive by the scorecards. Because of the combination of cost work on the other end, we actually only think that they're going to see 300 to 400 bips of cost pressure. And so the net is actually quite positive for them.
I think it's fascinating, Shawn. I mean, you're really talking about, in a way, zero-basing pricing as well as zero-basing costs. And what that tells me is that, the old cost playbook may work. You may need to reimagine it. You certainly need to become much more thoughtful about pricing. But in a way, you're kind of reimagining the entire way that you're delivering a product or service without dampening the customer experience. But let's go back and rethink, how do we actually do this? And are there some norms or mores of the past that we may need to break and do things in a different way, utilizing technology, utilizing simply different ways of doing business in order to deliver the same fantastic customer experience and do so at economics that are attractive to the firm?
Exactly.
Well, Shawn, it's been fascinating. Thank you again for coming by. I've learned a lot more about inflation today, and I'll be thinking about it the next time I go to the gas station.
Yeah, thanks again for having me.
I'm Hugh MacArthur. Thank you for listening.